could join us today, and we look forward to hearing his thoughts on how we can grow a strong economy while combating inflation. I'm looking forward to us all learning more about rising interest rates, maybe not rising interest rates, but interest rates in general, and how this will help us keep inflation levels down to keep the economy moving forward. On that note, it is my great pleasure to introduce Tiff Macklem, Governor of the Bank of Canada. Governor.
Well, thanks very much. What a pleasure it is to be here. Good afternoon to everybody. It's wonderful to be here in Halifax. It has been a tough couple of weeks for Atlantic Canada, and I want to begin by extending my condolences for the lives lost during this terrible storm. My sympathy goes out to all those affected across the region, including our Bank of Canada employees here at our office here in Halifax. The damage and the destruction bring a new wave of hardship after what has already been a very difficult couple of years. Canadians have faced historic challenges since 2020. And recovering from these challenges, just like rebuilding from the aftermath of Hurricane Fiona, will take time. Marie, I thought you put it very well. Unprecedented, unusual, unaccustomed. So much of the last 2 years has been like nothing we've seen before. The global COVID-19 pandemic has sparked a challenge that is particularly relevant to the Bank of Canada: high inflation. And that's what I want to talk to you about today. High inflation is making life more difficult for Canadians, particularly Canadians on low or fixed incomes. Now, some of this inflation reflects global developments, and we don't control those. But inflation in Canada increasingly reflects what's happening in Canada. The demand for goods and services here at home is running ahead of the economy's ability to supply them. Businesses are having a hard time finding enough workers. I was hearing about that at the table at lunch. And what started as high prices and delays for many internationally produced goods has broadened to many services. Au Canada, l'inflation a atteint 8,1% en juin, puis ça a baissé durant 2 mois. C'est une bonne nouvelle. Mais l'inflation ne partira pas toute seule. Pour la ramener à un niveau plus normal, nous devons freiner les dépenses dans l'économie. Comme ça, l'offre pourra rattraper la demande. Cela permettra de réduire les pressions sur les prix. En septembre, on a augmenté le taux directeur une 5e fois depuis mars. On a aussi indiqué qu'il faudra peut-être remonter les taux d'intérêt pour ramener l'inflation à 2%. La Banque annoncera plus tard en octobre sa prochaine décision de politique monétaire et elle mettra à jour sa projection pour la croissance et l'inflation. Inflation in Canada peaked at 8.1% in June, and it has declined in the last 2 months. That's welcome news. But inflation is not going to fade away by itself. To get it back to more normal levels, we need to slow spending in the economy so supply can catch up with demand. This will help relieve price pressures here in Canada. In September, we raised our policy interest rate for the 5th consecutive time since March. We indicated that interest rates will likely need to go higher still to bring inflation down to the 2% target. Later this month, we will take our next monetary policy decision, and at that time, we will update our economic outlook for growth and inflation. But today, I want to do 3 things. First, I want to unpack the run-up in inflation over the past year or so and review how the factors behind inflation in Canada are shifting from global to domestic and from goods to services. Second, I want to review the inflation indicators we are particularly focused on as we assess where inflation is headed. And finally, I want to acknowledge the hardship that high inflation is creating for many Canadians and underscore the imperative of bringing inflation all the way back to the 2% target. Heading into the pandemic in 2020, Canada's total CPI inflation was 2.2%, roughly on target. But when the world locked down, inflation fell steeply, dipping below zero. Prolonged deflation and economic depression were a big concern. The bank responded with exceptional monetary policy support, first to put a floor under the crisis, and then to help the economy regain its strength. And fortunately, combined with exceptional fiscal stimulus, it worked. We avoided deflation, and the deepest recession on record was followed by the fastest recovery ever. But repeatedly closing and reopening economies around the world brought new challenges. Households shifted their spending from in-person services to durable goods, and this strained global supply chains that were already disrupted by public health restrictions. Shipping bottlenecks and shortages of key intermediate inputs meant long delays for goods like cars, like bicycles, like appliances. So by 2021, we began experiencing higher prices for many internationally traded goods. As Chart 1 shows, inflation in goods excluding food and energy rose to about 3.5% by July 2021, while inflation in services excluding shelter was only around 1%. Add in higher global energy prices in 2021, and goods price inflation was about 4.5% by the middle of that year. With higher goods prices, total CPI inflation was moving up in 2021 too. But it was largely a story of higher inflation for global goods spilling into Canada. Inflation was rising in most advanced countries, and Canadian households were feeling the effects of higher global inflation. At the time, we assessed that the effect of these global forces on inflation was likely to be transitory. Historical experience has taught us that supply disturbances typically have a temporary effect on inflation, so we tend to look through them. A year ago, we expected inflation in goods prices to moderate as public health restrictions were eased, production ramped up, and investment in global supply chain logistics picked up. In hindsight, that turned out to be overly optimistic. Indeed, global inflationary pressures stepped up this year. The unprovoked Russian invasion of Ukraine in February drove up the prices of commodities further, particularly oil and the prices of agricultural commodities. And it created new disruptions to already impaired global supply chains. Canadians experienced these effects almost immediately with higher prices at the gas pump and big increases for many basic food items at the grocery store. But the other thing that changed this year was inflation in the prices for services. As the economy fully reopened in the spring, pent-up demand for all the services we've missed over the pandemic started to drive up their prices, especially in areas like travel and recreation. Canadians experienced these pressures firsthand when trying to book a campsite or trying to get a reservation to your favorite restaurant. Service price inflation rose quickly through the first half of 2022, reaching about 5% this summer. With further increases in good prices in 2022 and a rapid rise in service prices, total CPI inflation rose sharply, reaching 8.1% in June. Over the last 2 years, the pandemic and the war have affected lives and livelihoods. They've also had a profound impact on inflation. Our job at the Bank of Canada is to restore price stability. In the last 2 months, headline inflation in Canada has come down to 7%. This largely reflects lower gasoline prices. In mid-June, if you filled up your car in Halifax, you paid about $2.15 a litre. By the end of August, you were paying $1.64. More generally, there is some evidence that global inflationary forces have begun to ease, though they remain elevated. A range of global commodity prices are starting finally to come down from their very high levels. Oil prices have come down, and the prices for key agricultural commodities have also eased back a little. In time, with lower input costs and lower transportation costs, we should see food price inflation start to ease back. Bottlenecks have also begun to improve, and you can see that in this chart. Global manufacturers report that delivery times are still longer than usual, but they are getting shorter. And input cost pressures are easing. Global shipping costs have also come down from exceptional highs. These signs of improving global supply chains are encouraging. But we can't count on easing pressure on global prices to lower inflation in Canada. At a minimum, improving global factors will take time to filter through to Canadian inflation. And the recent depreciation of the Canadian dollar in the face of US dollar strength will offset some of the global improvement by making US goods and vacations more expensive for Canadians. There's also considerable uncertainty about the evolution of global supply chains and commodity prices. The global economy remains highly disrupted by the effects of the pandemic and the war in Ukraine. Predicting international price movements isn't easy, and the global inflation picture could change quickly. Unfortunately, we don't have much influence over that. We can't control global developments, but what we can do is we can use monetary policy to influence the balance between demand and supply in our economy, and therefore ease domestic inflationary pressures over time. All the signs today point to an economy that is clearly in excess demand. Labor markets remain very tight. Job vacancies have eased a little bit in recent months, but they remain exceptionally high. Our business surveys report widespread labor shortages, and wage growth has risen and continues to broaden. With demand running ahead of supply, competition is posing less of a restraint on price increases, and businesses are passing through higher input costs more quickly. As a result, higher energy and material costs are showing up in the prices of a growing list of goods and services. So even if there is some relief at the gas pumps, price pressures remain high and are still broadening. In August, the prices of more than 3/4 of the goods and services that make up the Consumer Price Index were rising faster than 3%. Simply put, domestic inflationary pressures have yet to ease. Now, that doesn't mean monetary policy is not working, but it will take some time. By raising interest rates, we're making it more expensive for households and businesses to borrow and therefore to spend. And in 5 steps since March, we have raised the overnight interest rate from 0.25% to 3.25%. And this is one of the steepest and fastest tightening cycles we've ever conducted. It's starting to have some effect. Some interest rate sensitive sectors of the economy have begun to cool. The housing market, which had overheated to unsustainable levels through the pandemic due to lack of supply, increased demand for larger homes, and low interest rates, is starting to cool. Higher interest rates are making it more expensive to borrow, and that is having a cooling effect on the housing sector. But monetary policy takes time to work its way through the economy. Households or businesses making a big purchase or an investment, something that requires a loan, they're feeling the impact already. It takes longer for monetary policy to bring down price growth in other goods and services, especially services, because they aren't tied directly to borrowing. Instead, they adjust over time as overall spending in the economy moderates. So what are we watching? In her September Economic Progress Report, Senior Deputy Governor Carolyn Rogers outlined what the bank is monitoring to guide our decisions in the months ahead. She explained that we will focus on how monetary policy is working to slow demand, how supply challenges are getting resolved, and most importantly, how both inflation and inflation expectations are responding. I want to drill down on these latter 2 elements, measures of core or underlying inflation and measures of inflation expectations. These are critical guideposts for us as we seek to bring total CPI inflation all the way back to the 2% target. As we look for a more fundamental turning point in inflation, measures of core inflation are becoming increasingly relevant. We're an inflation targeting central bank, and so we target the total CPI inflation, which is calculated using a basket of goods and services that represents what Canadians typically buy. But parts of the overall CPI basket are sometimes highly volatile, things like food and oil prices, and they don't reflect broader inflationary pressures. That's why policymakers like to look at what we call core inflation. We do that to try to gauge the persistent price movements. Core inflation provides a sense of the underlying trend in total CPI inflation, and it relates more closely to the balance between demand and supply in the economy. Now, in practice, there are different ways to measure core inflation. Traditionally, central banks in many countries have measured core inflation by excluding volatile components like food and energy. The drawback of these exclusion-based measures is that the components that are volatile can change through time, and we've lived that through the very unusual experiences over the last couple of years. We do continue to monitor various exclusion-based measures of core inflation, but since 2016, the bank has focused on three more statistical measures of core inflation. CPI median and CPI trim strip out whatever is most volatile at the time. The third measure, CPI common, is based on a statistical technique that captures the common component in the prices of many goods and services. And it captures the idea that inflation reflects a general increase in prices. Now, we use these three measures of core inflation because there's no single best measure. And depending on the circumstances, one can be a better indicator of inflationary pressures, and it's really their diversity that is their strength. With inflationary pressures as strong as they are, all three measures have risen, as you can see in this chart. They currently range between 4.8% and 5.7%. What they're telling us is that even if you take out the components of the CPI that are volatile or don't reflect generalized increases in prices, inflation is running about 5%. That's too high. We can also see that our core measures have yet to decline meaningfully, even though total CPI inflation has come down in the last couple of months. Going forward, we will be watching our measures of core inflation closely for clear evidence of a turning point in underlying inflation. Of our three measures, CPI common is becoming more difficult to use in real time because it has been subject to large historical revisions. With price movements becoming more generalized over the last year, what is included in the common component has changed considerably. CPI trim and CPI median, in contrast, are more robust to changes in the behavior of prices. These measures appear to have performed well and have been subject to much smaller revisions. With this in mind, we're more focused on these two measures of core inflation, and we are in the process of reassessing CPI common. The extreme events of the pandemic have stressed Canadians. They've also stressed some of our indicators and highlighted the benefits of a variety of measures. In addition to measures of inflation, we're also closely watching inflation expectations. Keeping longer-term inflation expectations of inflation well anchored is paramount, so that as inflationary pressures ease, inflation returns all the way to the 2% target. The longer high inflation persists, the more pervasive it becomes, the greater is the risk that high inflation becomes entrenched. In particular, if high inflation pushes wages up and higher labor costs then push inflation up further, inflation expectations could become unmoored, and high inflation could become self-fulfilling. We can't let that happen, because if it does, it'll be much more difficult to get inflation back down to the target. That's why we're so focused on measures of inflation expectations. We use a range of surveys and market-based measures to assess expectations of future inflation. And they show us that near-term expectations have risen. Surveys also indicate that consumers and businesses are more uncertain about future inflation, and more of them expect inflation to be higher for longer. So far, longer-term expectations remain reasonably well anchored, but we're acutely aware that Canadians will need to see inflation clearly coming down if we're going to sustain that confidence. This increased uncertainty heightens the risk that inflation expectations could become de-anchored. And in our surveys, what we see is that both households and businesses view inflation pressures as mostly global, but increasingly they are identifying domestic factors, which is very similar to our own analysis. Results from our next consumer and business survey, which will be released later this month, will be important for our assessment of how expectations have evolved. It's time for me to conclude. Low, stable, and predictable inflation is fundamental to a well-functioning economy with sustained growth and shared prosperity. That's why price stability is the main objective of monetary policy in Canada. Without price stability, nothing works well. High and unpredictable inflation creates uncertainty and unfairness, distorting decisions and undermining confidence in our economic system. It erodes the value of money. It distorts and confuses the information and incentives that consumers, entrepreneurs, savers, investors all rely on to make their economic decisions. That means workers and businesses have less to show for their work, and it's harder for everyone to plan for the future. Plain and simple, high inflation feeds frustration and creates a sense of helplessness. We want an economy where households and businesses don't have to guess where inflation is going to be. We want an economy where the money Canadians earn from their hard work keeps its value. We want an economy where businesses have the confidence to invest. And we want an economy where workers make real wage gains underpinned by rising productivity. That's why we have taken forceful action to restore price stability. We've raised our policy interest rate by 3 percentage points this year in 5 steps. And we are reinforcing these increases with quantitative tightening. Looking ahead, the Governing Council recognizes that it will take time for past interest rate increases to have their full effect on the economy and inflation. That's why we'll be carefully assessing the effects of our actions as we seek to slow spending and return inflation to the 2% target. Canadian economic data over the summer have come in largely in line with our July outlook, and forward-looking indicators suggest the economy is slowing. However, labor markets remain tight, the economy is in excess demand, and we have yet to see clear evidence that underlying inflation has come down. When combined with still elevated near-term inflation expectations, the clear implication is that further interest rate increases are warranted. Simply put, there's more to be done. We will need additional information before we consider moving to a more finely balanced decision-by-decision approach. On le sait, le retour à la cible de 2%, c'est pas pour demain. Il nous faudra du temps. Ce ne sera pas facile, mais on ne peut pas se permettre de laisser une inflation élevée s'installer. Les provinces atlantiques vont reconstruire après la tempête, comme toujours. Et la Banque du Canada va contrôler l'inflation comme elle le fait depuis 30 ans. Nous allons rétablir la stabilité des prix pour tous les Canadiens. C'est notre engagement. We know we are still a long way from our 2% target. We know it's going to take some time to get there. We also know there could be setbacks along the way, and we can't afford to let high inflation become entrenched. Atlantic Canadians, we will rebuild after this storm, as they always have. And the Bank of Canada will control inflation as it has for the past 30 years. We are resolute in our commitment to restore price stability for all Canadians. Thank you.
Thank you very much, Governor. Appreciate that. Very helpful perspective. I love the graphs. They tell a bit of the story. Now, I want to start off with, I understand the Bank of Canada is looking for a part-time deputy governor. And I wondered if you wanted to take my resume now or wait till the questions are over. See how I do? We'll wait to see how I do. Okay, all right. That couldn't be too controversial.
Can I ask you some questions?
No. I get to ask the questions.
Darn.
It's not the way
more
it
fun.
works. Yeah, it would be. You'd probably have better questions than mine. So a number of questions. So we've seen a notable depreciation in the Canadian dollar in the last week. We know that a lower dollar can pass through inflationary pressures from import prices. At what value does the Bank of Canada become concerned that costly imports are themselves becoming a driver of inflation that must be tackled through stricter monetary tightening?
Well, as you mentioned, Canadian dollar has depreciated in the last several weeks. Just to give you a bit of broader context, the U.S. dollar has actually appreciated considerably over, really the last year now. And through most of that period, actually, the Canadian dollar was relatively stable against the U.S. dollar. So actually what was happening was it was appreciating against most other currencies. In the last several weeks, yes, as you indicated, the U.S. dollar has taken another leg up, and the Canadian dollar has depreciated against the U.S. dollar. So yes, what that means is that imports of American goods into Canada, U.S. vacations, will become more expensive. As I mentioned in my remarks, we're starting to see some easing in global inflationary pressures. They're still elevated, but there are some signs. Oil prices are down. Prices of wheat, some key agricultural products have come off a bit. That should feed through. However, the depreciation, if it's sustained, will be a countervailing force. So, I mean, what all that comes down to is normally when we raise interest rates, the exchange rate actually appreciates, and so that does part of the work for us. This time, that's not happening. So other things equal, as economists like to say, that means we have more to do with interest rates.
Okay, great, thank you. We're lucky to have the Nova Scotia Minister of Finance here, so we won't pick on Nova Scotia. We'll pick on Newfoundland today. So Newfoundland yesterday announced a $200 million spend to help consumers recover from the impacts of increased costs, which will give $500 to every family who earns under $100,000. So I guess I'm wondering, are governments helping you fight inflation, or are they not helping you fight inflation?
Well, let me say a couple of things here. First of all, I have a big enough job with monetary policy. I will leave fiscal policy to our ministers of finance across the country and ultimately parliaments across the country. I will say that I think the advice that the IMF has put out is good advice for everybody around the world. And their advice, look, we are acutely aware that inflation is creating hardship for Canadians, and it's particularly creating hardship for the most vulnerable Canadians, low-income Canadians, people on fixed incomes. And the reason it's particularly acute, obviously, they have fewer buffers. But the other factor is some of the biggest price increases have been in essential goods, energy prices, rent, food. These are not things you can do without. So there is real hardship, and governments are quite sensibly looking at how do you insulate your most vulnerable from that. The advice from the IMF, which I think is good advice, is make sure that those measures are targeted on the most vulnerable, and make sure that they're temporary, because as I've said several times already, this inflation is not here to stay. It's coming down. The best way to protect Canadians from high inflation is to eliminate it.
I agree. So focused on perhaps wages at this moment, and I have written in my notes here unions, but it's actually every employer and employee are currently thinking about wage increases. And with inflation over 5%, I suspect there will be some significant wage increases over time. Will these wage increases create a cycle of, I hate to call them wage and price controls because that's a terrible term, an old term, but will this create a cycle of increased interest rates? What should Canadian employers be thinking about to ensure that interest rates and inflation are minimized?
A couple things here. Look, it's up to, we have many labor markets in this country. We have we're a vast country, and we have many sectors. And it's up to businesses. Certainly over lunch I was hearing about the labor shortages here in Atlantic Canada. Look, it's up to businesses to figure out what they need to pay their workers. It's up to workers to figure out where they want to work and what they want to work for. What I've been telling workers, what I've been telling businesses is, as you take your decisions, don't plan on inflation staying where it is. Don't plan on 7 or 8% inflation. We are taking forceful action to bring inflation down. We are starting to see some effects. Some sectors, the most interest-sensitive sectors of the economy are cooling. Those interest rate increases will feed through to the broader economy. They will dampen spending, bring demand and supply into better balance, and that will relieve those inflationary pressures. It's going to take some time. But monetary policy works, and inflation is coming down, and businesses and workers can count on that. The second thing I'd highlight is an important reason we have been front-loading our interest rate increases, moving interest rates up rapidly, is to make sure we keep those inflation expectations well anchored, and that is precisely to avoid the possibility of a wage price spiral. Because once you get into a wage price spiral, it's too late. And once that happens and inflation expectations become unmoored, move above the target, then in order to get inflation back to target, we will have to send interest rates considerably higher. We will need a much more marked slowing in the economy. And by front-loading, by moving our interest rates up relatively quickly, we're sending a clear signal. We are resolute in our commitment to bring inflation down, and by keeping those inflation expectations anchored, as those international and domestic price pressures ease, inflation will come back to the 2% target.
So to be specific, if you were to offer forward guidance about interest rates in the current tightening cycle, under what conditions would the Bank of Canada pause its interest rate increases?
Okay. Well, first of all, as I said, our next decision is later in October, and I'm not going to front-run that decision. And at that time, we will publish our updated economic outlook. What I will say is we've been pretty clear that interest rates need to continue to move up. In September, we raised our policy interest rate by 75 basis points, an unusually large step, to 3.25%, and we indicated that we expected interest rates would need to rise further, and today I reiterated that further interest rate increases are likely warranted. Now, as I've emphasized, we recognize that it's going to take some time for the interest rate increases we've already put in place to work through the economy, and we're going to be assessing their impact, and we're going to be assessing how much further interest rates need to go to bring inflation all the way back to the target. What I can tell you is what we're particularly looking at to make that assessment. And as I mentioned in my remarks, Senior Deputy Governor Rogers a few weeks ago outlined the three big things we're looking at, and those are how the interest rate increases we've done feed through to slowing demand, how the issues we've seen in global supply chains and Canadian supply chains, how those are getting resolved, and then most importantly, how's actually inflation and inflation expectations evolving. How high interest rate needs to go for how long is going to really depend on how inflation and the economy evolves. What I can assure you is that we are committed to restoring price stability, and we're going to use our interest rate to bring inflation back to target.
The last few years have been difficult, as you mentioned. What is the capacity of Canada's economy to endure, if you will, another economic shock? Although the economic shock that we thought we were going to get with the pandemic didn't seem to be as dramatic, or we certainly rebounded quite significantly. Does Canada have the ability to weather an unforeseen economic storm in the near future, or has COVID deteriorated our financial ability to address another shock?
Well, obviously, we've all been through a lot, whether it's households or businesses or governments, and so that we can't change that. The good news, as you indicated, is yes, we had the deepest recession on ever, but we had the fastest recovery. Our economy is very strong. In fact, it's in excess demand. It's running too hot. We actually need to cool spending and bring it in line with supply and give supply a chance to catch up. I think the best thing we can do is to, we've raised interest rates. The best thing we can do is get inflation down, get things back more to normal, and that is going to put us in the best position to handle future shocks. With inflation running at 7%, we are more concerned about the upside shocks to inflation than the downside. We certainly wouldn't want to see inflation go up further. We are looking for it to come down.
Okay. Many Canadians have had their personal wealth tied up in real estate, with home prices basically increasing for the last 25 years. Now with housing prices in seeming decline, although I'm hoping many of the real estate agents in the room would disagree with me. Many people have used this accumulation of wealth, or at least paper wealth, in their retirement planning. What would you tell them to give them comfort if houses are headed down in price?
Well, we've been highlighting at the Bank of Canada for some time that high house prices and high household indebtedness to buy those houses, it is a vulnerability for the Canadian economy. In the last, through the pandemic, with the exception of the very first part, we saw a very hot housing market. And this was driven by a few things. First of all, the simple reality is we were all at home. We were all working at home. Our kids were studying at home. All our recreation was at home, and people wanted bigger houses. Interest rates were low, and we saw a real boom in housing, an unsustainable boom. Housing prices on a national basis were up slightly over 50% in the last 2 years. Housing has been unsustainably strong, and with the increases in interest rates, you are seeing that cooling. You are seeing housing cooling. That is part of bringing demand and supply back into balance in this economy. And you've seen some modest house price declines. Different parts of the country, it's different. The declines actually in Atlantic Canada, you didn't get as much of a boom. You aren't seeing as much weakening as some of the bigger markets in Canada, where we've seen more exaggerated movements on both sides. The slowing, housing could not stay as strong as it was. It was unsustainable. It needs to slow. That's part of the adjustment that we need to bring inflation down.
Okay, great. So
I'll just add one thing.
Yeah, please. Yeah.
The fact that households are more indebted in Canada, that is something we're well aware of. And when I talked about we're going to be assessing the impact of higher interest rates on demand, we are factoring that in. We know that, other things equal, if you've got more debt, you're going to be more sensitive to interest rates. So that is something that we're factoring in. But there are also other things that we need to factor in. The other thing, sort of on the other side of the ledger, is that households built up what we call excess savings. Only an economist would come up with that kind of a word. Excess savings. So there were many things that we couldn't, many things we like to buy, many services, vacations, that we couldn't buy over the pandemic. And so people save money, and they've got those balances. Most of those balances are still sitting in their bank accounts. So they have some extra liquidity. So on the one hand, they're more indebted, and interest rates might have a bit more traction than they have historically. On the other hand, they've got some excess savings, which gives them some more ability to absorb higher interest rates. So those are sort of two of the key factors we're looking at as we assess how much effect the increase we've done in interest rates will have on slowing demand.
Great, thank you. I think we've only got time for one more question. So with recession concerns, and I understand there seems to be a bit of obviously a balance that the Bank of Canada needs to try to get us to less inflation, but we don't want to tip into a recession. With that balance in mind, what should Atlantic businesses be doing to prepare for 2023? Is there any advice you could provide for them?
Well, you know your businesses better than I do. And I will say, as the Governor of the Bank of Canada, I have been incredibly impressed with the resilience, the innovation we've seen in the business community across this country to figure out how to get your employees, at least the ones that could, to be able to work at home, how to serve your customers remotely. This could have been a lot worse, but thanks to a lot of nimbleness, innovation, adaptability, resilience, grit, we've got through this much better than we expected. You know, with respect to there is a lot of talk about recession. Let me just say a couple things. First of all, our mandate is clear. Our mandate, our primary responsibility is price stability, to return inflation to the 2% target. We want to do this in the best way possible. Right now, demand is running ahead of supply. We need to cool spending. We're going to need a period of below trend growth so that supply can catch up with demand. But below trend growth is low growth. It doesn't need to be a recession. Below trend growth, low growth, that's the soft landing. And by raising interest rates quickly, what we're trying to do is avoid the need for even higher interest rates in the future and a sharper slowing. As I mentioned, front-loading our interest rate increases is the best chance to a soft landing. Now, whether we can get to a soft landing or not is going to depend on a number of factors. It's going to depend on how quickly or how slowly these global supply chain issues get resolved. It's going to depend on how sticky inflation is in Canada, and as I've stressed, it's going to depend importantly on how well anchored those inflation expectations remain on the 2% target. The path, what I would say to the business community, to all Canadians, is there is a path to a soft landing, but it is a narrow path, and there are risks, and yes, you should be factoring those into your decisions. But I will go back to where I started. Inflation is a burden on all Canadians, and this is probably the best place to end since it's the last question. We are determined to do our job and get inflation back to 2%.
Perfect. Thank you very much.
Thank you. Thanks.
Good afternoon. My name is Rebecca Spence, Press Officer for the Bank of Canada, and I will be moderating this press conference. Governor Macklem will be pleased to take questions for about 20 minutes. Before asking your question, please state your name and affiliation. We are webcasting this press conference, so if you're in the room, please use the wireless microphone, which someone will bring to you if you raise your hand. We also have some journalists participating via teleconference today. So we'll do one question in the room first and then turn to the phone lines to try to make sure everyone gets a chance to ask their questions. Time permitting, we will do a second round, but my list is very long. The governor will be happy to answer questions in both official languages. Avant de poser une question, prière de vous identifier. Je vous demanderai également d'utiliser le micro sans fil. Libre à vous de poser vos questions dans la langue officielle de votre choix. So we're going to start in the room with John.
Mr. Macklem, you indicated that we're going to see more rate increases. What would you say to the homeowners and business owners of Atlantic Canada, Nova Scotia, who are going to feel those increases acutely?
Look, we're aware that higher interest rates are creating some difficulty for some Canadians, and certainly if you've recently bought a house and you have a variable rate mortgage, yes, you are going to feel some pressure. We are aware of that. We know Canadians are more highly indebted. We are taking that into account as we raise interest rates. We do need to slow demand in the economy. Our economy is running. Demand in our economy is running ahead of what the economy can produce. Demand is here, supply is here. That's putting upward pressure on prices. We do need to cool the economy, and yes, we are starting to see some slowing in the housing sector. That is part of the process of cooling the economy. The housing sector has been unsustainably hot. But we certainly are conscious. We are looking for those effects. We don't want to overcool the economy. We think there is a path to, we definitely need lower growth. We need a period of below trend growth to get better balance between demand and supply and relieve those inflationary pressures. And we will be watching closely how our interest rate increases feed through to the economy and inflation.
We'll go next to Stefan.
Hi there, I'm Stefan Sinclair Fortin with All Nova Scotia. I guess with everything that's going on both within Canada and internationally, is there one thing that you're most concerned about, or I guess what keeps you up at night?
Well, the short answer to that question is I'm not going to sleep easy until we get inflation back to 2% target. Inflation is 7%. That's too high. Even when you strip out volatile components, when you strip out pieces that aren't sort of generalized increases in prices, you're still left with inflation around 5%. And increasingly, the inflation that we're seeing in Canada reflects what's going on in Canada. As I just mentioned, we've got an economy that's in excess demand. In other words, demand for goods and services in the economy is running ahead of the economy's ability to produce those goods and services. That's creating inflationary pressures. And Canadians are seeing that. They're seeing it in delays in getting goods. They're seeing it in, it's hard to book a campsite or get a reservation at a restaurant. Businesses are seeing that. They're having trouble finding workers. They're having trouble keeping up with demand. So we do need to cool spending. We do need to get inflation to come back down. And so far, yes, headline inflation has come off. That is certainly welcome news. But we haven't seen a turning point, a clear turning point in underlying measures of inflation. That's something we're looking for. We'll start to feel a little better when we see that. But as I said, we're not going to sleep easy until the job's done and we're back to price stability, 2% inflation.
And we'll just go to Jesse at the back here.
Jesse with CTV Atlantic here in Halifax. You said the interest rate will likely have to go up higher in the short term just to tame the inflation. But I'm wondering, are we seeing any concrete examples of the increased rates having an impact on inflation already, perhaps globally and domestically here? Some examples.
Well, two parts to that answer. First of all, inflation is a global phenomenon. Many countries have seen large increases in inflation. Inflation in the U.S. it's 7% in Canada. It's 8.3 in the U.S. I think it's 9.1 in the Eurozone. And so you're seeing central banks around the world raise interest rates to try to cool spending and control inflation. And I'll speak to what we're seeing here in Canada. Those interest rate increases, we are starting to see cooling in the interest-sensitive parts of the economy. So the clearest example of that would be the housing sector, where most people buy a house with a mortgage, so immediately higher interest rates mean higher mortgage rates, which makes it tougher to buy a house, and so you see some cooling in the housing market. The housing market was running very hot through the pandemic. It needed to slow. That's part of the slowing process. Where you'll see the other first effects are other things that you need, that you typically buy on credit, things you buy with a loan. Other goods and services, especially services, it'll take longer for inflation to come down in those areas because you typically don't buy those things on credit. So we are starting to see monetary policy working. It is going to take some time to feed through the economy, and as I indicated earlier, we do think further interest rate increases are warranted to get inflation all the way back down to target. But monetary policy does work, and it will bring inflation down, and Canadians can be confident that inflation is coming down.
Thank you. That's all the questions in the room, so we're going to now turn to the phones. So we'll go to Craig at Global first, followed by Mark at the Globe. So go ahead, Craig.
Hi there. Yep, Craig from Global News. Governor Macklem, you spoke a lot about how there are signs of easing inflation on the global scale, but the domestic fuel is still hot, a lot of services spending. I'm curious, how does that shift affect your ability to fight inflation? Is it easier at all? Is it more challenging? Can you talk about the impact of that shift?
Yes, as I mentioned, global inflationary pressures are still elevated, but we are starting to see some early signs that global inflationary pressures could be easing. That is certainly welcome news, but a couple of messages. One, we can't count on global developments to bring inflation down in Canada. Global prices are very hard to predict. There's a lot of uncertainty. We're still dealing with the ramifications of COVID. There could be new waves. China is struggling with new lockdowns that could further disrupt supply chains. There's a war in Europe. So there's a lot of uncertainty about global developments. We can't control them. What we can influence, though, as the Bank of Canada, is the balance between demand and supply in our economy, and therefore inflationary pressures in Canada over time. And right now, the economy is clearly in excess demand. You see that in labor markets. Businesses can't keep up with the demand for goods and services that their clients want. That's creating price pressures here in Canada. By raising interest rates, we will slow spending growth in Canada. That'll start to bring demand and supply into better balance. That will relieve price pressures in Canada. So I don't want to pretend it's easy. Assessing the multitude of forces on the economy and exactly how much is needed is difficult. We don't want to overcool the economy, but we really want to make sure that we keep inflation expectations anchored and we bring inflation back to target. High inflation is harming all Canadians, and we need to eliminate it.
We'll go to Mark.
Hi, Governor. Thanks for taking the question. Mark Randall from the Globe. You spoke in the Q&A and again just now about the possibility of a soft landing in Canada, similar to the language you used over the summer. Since then, we've obviously seen a lot of negative things in the kind of broader global economic picture, with the Fed signaling it's going to tighten more, European energy prices getting worse. Has the path to a soft landing narrowed since you spoke about it in the summer? And at what point is it reasonable to stop talking about the possibility of a soft landing?
Well, Mark, I don't have a revised forecast for you. We'll have a revised forecast later this month when we publish our monetary policy report, and so that'll have a revised forecast for growth, revised forecast for inflation, as well as a discussion of the risks around that forecast. You know, I would say two things. First of all, we think the best chance of getting to that soft landing is to front load those interest rate increases, and that's what we've been doing. And the reason that's the best chance is that by front loading the interest rate increases, we'll start to get demand reasonably soon, moving into better balance. Inflation should start coming down, and importantly, it should be very helpful in keeping inflation expectations well anchored. One thing we know for sure is that if inflation expectations become unmoored, they move up, we will need considerably larger interest rate increases, and that likely would mean a real recession to get inflation back down to target. In our monetary policy report in July, we actually put a risk scenario in there that showed what that could look like. By front loading, we're really trying to avoid that. That's the best chance of the soft landing. Whether we get a soft landing or not is going to depend on a number of factors. It's going to depend on how quickly or how slowly these global and domestic supply disruptions get resolved. It's going to depend on how sticky inflation is in Canada, and as I've already stressed, it's going to depend importantly on how well anchored our inflation expectations stay on the target. But you know, sort of let me go back to the basics. I mean, the basics are our mandate is clear. Our primary responsibility is price stability. That's get inflation back to 2%. We're determined to fulfill our mandate.
Thanks, Mark. The next journalists I will call on will be Dave from BNN, followed by Najud, and then Julie. So go ahead, Dave.
Okay. Hi, Governor. Last week, we had a guest on BNN Bloomberg who was quite critical about the Fed and the Fed's recent moves, and he called officials there, quote, incompetent. I'm just wondering, how do you respond to the amount of criticism that central bankers have recently had to face amid a tightening cycle that has transpired amongst global central bankers, not just the Bank of Canada, but all across the world?
Look, inflation's too high. And frankly, Canadians should be asking us some tough questions. Inflation is 7%. Yes, it's come down a bit from 8%, but it's 7%. That's still too high. And as I outlined in my remarks today, even if you take out volatile components and you know, it's still, you just look at service price inflation, it's still around 5%. So we should be getting some tough questions. And look, we welcome commentary. We welcome analysis. We welcome criticism. How are we dealing with it? Well, we're doing a few things. First of all, we're very focused on achieving our mandate. You know, we're happy to see that Canadians, by and large, have confidence. Longer run inflation expectations do remain well anchored. I think that is a measure of confidence in the central bank. But we're acutely aware that, you know, we need to reward that confidence. Canadians will need to start to see that underlying inflation is starting to move down towards the target to maintain that confidence. So, you know, first thing is we're very focused on achieving our mandate. The second thing is we're working harder to listen to Canadians, to understand Canadians' perceptions, to understand Canadians' concerns. And I and my colleagues have been going out of our way to talk more frequently, more directly to Canadians, using more channels, so mainstream media, but also using social media channels to try to reach people where people want to be reached. You know, one thing we know is that the more people understand about our mandate, the more people understand about how we go about achieving our mandate, the more confidence they tend to have in the Bank of Canada. So that's how we're handling the criticism.
Thanks, Najud.
Hi, Governor. So many of us have characterized the bank's recent communications as being hawkish, and the bank itself has talked a lot about the importance of communicating about what it plans to do and its commitment to bring inflation down. At the same time, it feels like some have underestimated how far the bank would go. So I'm just wondering, do you feel like the bank's message is landing, specifically with markets, or is there a disconnect?
Look, I think as I mentioned, we're happy to see that longer run inflation expectations remain reasonably well anchored on the target. I think that is a measure of the fact that there is confidence that the Bank of Canada will bring inflation back down. With respect to whether the message is landing, look, I mean, we've raised interest rates unusually rapidly over the last number of months. I think that has had an impact. I think that has reinforced the anchoring of inflation expectations further out the curve. The fact that total CPI inflation has come down from 8.1 to 7, that is helpful. That is welcome. I think the next thing, as I said, we're looking for is clear evidence of a more fundamental shift in underlying inflation, and I think we'll feel a bit better when we get there. Look, I think we've been very clear about the things that we're looking at. We're looking at how our interest rate increases are affecting demand. We're watching how global and domestic supply chain issues are resolved. We're watching, I spent a fair amount of today talking about measures of underlying core inflation and measures of expected inflation. I think by being clear about what we're watching, I think that helps the market digest incoming news as it comes out. So in that sense, I think we're looking at the same things.
Julie?
Hello, Governor. Thanks for taking our questions. I want to ask you about the transparency review and specifically about the summary of deliberations. Now, this won't be, from my understanding, traditional minutes. You don't actually vote on decisions. You do by consensus, so we won't see that. And there also will not be attributions in it. So I'm just wondering how you see this really improving transparency considering these limitations. Thank you.
Well, first of all, I don't really see them as limitations. I think our consensus-based system for us is a strength of our system. I think it encourages, it encourages a real back and forth. As the person who chairs the governing council, it encourages colleagues to really listen to each other and look for the points in common and then understand the points of tension. And I think that is a benefit. And how the summary of deliberations, I think how that will help. Just to give you a practical illustration, when I give a press conference after at the time of the monetary policy report, in the opening statement, I typically highlight some of the key points in the deliberations, and I think what you can expect in the summary of deliberations that we'll publish a couple of weeks after is an elaboration on that. What were the key points of focus in the discussion? What were the options that we were discussing? What were the risks? How did we reach a consensus? And why we decided what we decided. So the idea is, as I say, I think it'll elaborate. We've been doing this to some extent in the opening statement. The summary of deliberations will be the opportunity to do this in a more fulsome way, and hopefully that can add transparency to our thinking, why we took the decisions we took. And really what we want is we want everybody to sort of understand what we call our reaction function, how we process incoming information, and what are the things that'll be paramount in our decisions. That should help make our decisions more predictable, and that'll make them work better.
Okay, so we're closing in on our time, so we're going to go to Bloomberg, then Market News, and we'll end with Dow Jones. So Theo, go ahead.
Good afternoon, Governor. Theo Argyris with Bloomberg News. You face some backlash with your comments around wages, and you're talking even today on your speech around the potential for a wage price spiral, but it all seems sort of vague. Wondering if you could be specific. Can Canadian workers, or should Canadian workers, try to seek to at least make up for inflation in their wage demands, or do wages have to be, or real wages have to be negative for a certain amount of time to avoid a wage price spiral?
So Theo, look, we have many labor markets in this country. We have a very big country with many sectors, and different sectors are in a different situation. Businesses, they know their business. They know how hard it is. They know how much difficulty they're having attracting workers. They know who they're competing against. They've got to take their decisions, and workers. Workers need to take their decisions about the conditions they want to work with, and the wages that they're getting paid. And I'm going to leave those decisions to the businesses and the workers. Really, our message is that as a worker, as a business, as you're taking those decisions, don't count on inflation staying where it is. 7% inflation, we're not staying there. We've moved forcefully to increase interest rates. That is starting to cool demand. It's going to take some time, but that will feed through the economy, and inflation will come down. And you should be planning on that basis. Yeah, I don't think I have anything to add beyond that.
Okay, we'll go to Greg.
Hello, it's Greg Quinn with Market News International. Governor, I think you noticed that central banks around the world being blamed for missing the jump in inflation. You're now speaking about a path for a soft landing, but you're also the most aggressive central bank in the G7 on rate hikes. Does this kind of tough language and policy put you at risk of again facing blame from the public if Canada ends up in a recession?
Greg, look, all I can say is that all our decisions are grounded in our mandate. High inflation is harming Canadians. Our mandate is very clear. Our mandate is price stability, 2% inflation. We're a long way from there. We've taken forceful action to bring inflation back to target. As I've indicated, we think there's more work to do. We're going to be assessing the impacts. We clearly want to do this in the best way possible. Our economy's in excess demand. We don't want to choke off demand. We want to get rid of the excess. We want to bring demand and supply into balance, and that's going to relieve those inflationary pressures. We definitely need to see growth slow. We do think there's a path with below trend growth that's not a recession, but as I said to one of the previous questions, it is a relatively narrow path. There are risks, and we will certainly be assessing those going forward. But at the end of the day, it's clear our mandate is price stability, and we're resolute in our commitment to restoring price stability.
And so we'll go to our last question, which is Paul.
Paul Vieira from the Wall Street Journal. Governor, will further depreciation of the Canadian dollar relative to the U.S., will that influence rate policy decisions in the near term?
Well, I'm not going to predict the Canadian dollar, but what I will say is that normally when we raise interest rates, the exchange rate appreciates, and that usually, that's part of the transmission mechanism, because as the exchange rate appreciates, well, higher interest rates dampen domestic spending. An appreciating exchange rate dampens our export growth and tends to increase imports. So the contribution of net exports to growth diminishes. We're not getting that this time, and we can talk about that if you want. But what that does mean is that, other things equal, there's going to be more to do on interest rates. So the flexible exchange rate system, it's what gives us the ability to run an independent monetary policy that is geared to the needs of Canada. It's an important element, and we're going to take those exchange rate movements into account as we move forward and decide on what we need to do on rates.
So that concludes the press conference. Thank you all so much for coming today.
Thank you very much.